I'm here with Stefan Worm. He has done this amazing research about how marketing affects firm performance.
What we do in this study is that we look at how marketing affects financial KPIs of firms. In particular, we have taken 200 studies from the marketing literature that have all examined in some way how marketing variables of different kinds affect financial KPIs. And we're compiling the results across those 200 studies, aggregating, comparing, and drawing conclusions to generalize. In particular, we are interested in two blocks of marketing. First of all, what firms do with respect to marketing. That comprises how market-oriented they might be, whether they advertise, how they innovate with new products, whether they do research and development. And then the next big block is what customers do and think. So this comprises a brand image, reputation. It also comprises customer satisfaction, and then loyalty behaviors that are captured in, for example, customer lifetime value. And we examine how these two blocks, what firms do and what customers think and do, impact on the firm's financial key performance indicators.
Right. And what would you say are the most important findings?
I would say that there are three key findings to this research. First of all, we find that there is a chain of effects for marketing productivity, as we call it. So what firms do, whether they advertise, whether they innovate, impacts how customers think about the firm and its products and what they do about the products. So whether they are satisfied, whether they have esteem for the brand, and then how loyal they are, whether they buy from that brand. And that in turn affects the firm's financial KPIs. That's the first major finding. The second major finding is, as we're looking into how these two blocks of marketing activities and concepts impact financial KPIs, is that the impact of marketing really differs largely between the KPI that you choose. So depending on whether a manager wants to maximize the value of the firm in the stock market or whether they care about growing sales, activities will have different effects and very often asymmetric effects. So for example, investing into higher customer satisfaction will lead to an increase of the stock price in the stock exchange, but it will at the same time reduce the sales growth of the firm. So the manager really needs to decide there which KPI they are in for and then prioritize their activities. And the third major finding is that for across the different marketing activities, we see different impact on KPIs. For example, if we're interested in growing sales as a manager, satisfaction, as I already said, will lead to a reduction in sales for that company, whereas higher brand esteem will be growing the brand, and to a lesser extent, investment into advertising will also produce a small but noteworthy boost in sales.
Right. So if you would have to advise managers based on your findings, what would be your takeaways from this study?
So the key takeaways from these three blocks that I just mentioned are that managers need to prioritize their investments because they have limited budgets to spend in marketing. They need to first identify what the key KPI is. So what do their investors care about? What is their compensation tied to? And what would be strategically implied for the firm? They select, for example, that it is sales that matters most, or alternatively that it's profit that matters most. And based on that, they will select the marketing investments that drive those sales most. And so our study provides clear recommendations depending on the KPI that they have on where to invest. We would recommend them to look at those findings in detail, and moving beyond that, we would recommend that companies build an empirical model for their own firm to show the chain of marketing productivity, to find out in a very detailed way how, for example, an investment into advertising, into a new campaign, for example, on social media and in digital media will lead to performance in a KPI, as opposed to, for example, investing into better customer service to boost satisfaction. So in the end, we recommend that they replicate what we do for their own business to have a very clear prediction and clear investment priorities.
Yes. So your study summarizes quite a few existing studies. Did you, based on that, identify any issues, remaining issues that you think that the literature should address in the future?
So there is a significant amount of research, but what is still missing is academic studies of primary empirical studies that take into account a broader set of variables, just as we did in this meta-analysis, to examine this chain of effects and to see how various variables act in conjunction and how they work together. And that is something that moving forward we would like to see academic research do for the results to be more helpful to managers.